For the past few months, we've been trying to work out whether the turmoil in markets was just noise or whether there was a signal about some underlying problems in the world economy. Our view was it was mainly noise, and if you look at the data over the past few weeks, it supports that interpretation. And if you look at the economic surprise indicators, for example, they remain very benign. Now you can understand why central banks are not so relaxed. They're very conscious of the downside risks, and that's why the ECB was easing policy in March, and also why the Fed was sending a very dovish message. I do doubt that the Fed can be quite as dovish as it's signaling at the moment. Underlying inflation is rising. The core inflation numbers have ticked higher. I think that will push the Fed to raise rates by June and probably another 2 times before the end of the year. But overall, it's a very benign outlook. The global economy remains on path for a solid 3.5% growth year, and central banks are going to keep on being supportive for several more months to come.
The title of our April monthly investment guide is Reprieve for Emerging Markets. Indeed, what a difference a month can make. Investors are now having a renewed enthusiasm for risk assets, a stark contrast to when the year started. Investors' newfound optimism is not unfounded. The improvement in global economic data, coupled with the delay in Fed's rate hike and ECB stimulus, helped to ease recession fears. The Fed's dovish guidance was a game changer. A pushback in US interest rate increase meant that the dollar rally would likely take a pause, reducing China's devaluation pressures and pushing commodity price higher. This calmer macro condition induced a resurgence of fund flows into emerging markets, searching for higher returns and yield. Before the Fed restarts its hiking cycle again, there is a window of opportunity for emerging markets to do well, especially in the second quarter of 2016. Therefore, for this month, we are expressing our positive view on emerging markets by upgrading our tactical call on Asian equities to overweight, as we assess Asian corporate growth to have bottomed and valuations remain attractive. Taking a step back, the outlook for the global economy looks solid, and consumer confidence were unaffected by the recent market turmoil. Hence, we think that the medium-term appreciation of risk assets can continue, but may face some headwinds along the way. To be sure, market volatility will return. We would caution about being too complacent that the Fed will keep its dovish tone indefinitely. Furthermore, political risk appears to be growing with Brexit and US presidential election. Assessing the balance of risk and reward, we hold on to our overweight call on equities. At the same time, we remain positive on emerging market high-yield bonds, which will benefit from the renewed interest in high-yielding assets.